I want to get, I'm under instructions to get things on time here and keep things on time. So I'm just going to spritz and disinfect the pointer here real quick because you don't know who has been shaking hands with the people who have previously presented up here. You know, the old Chinese saying, may you live in interesting times. I never really thought that they would actually provide the interesting times for us, but apparently they have. Unlike Eric, I did not stay up late last night revising my presentation. I emailed it in Thursday after the market and haven't touched it since. So we're going to be a little bit out of date because a few things have changed since then, as you may have noticed. But on that note, who knows what's going to happen Monday? Anybody know what's going to happen Monday? Raise your hand if you do. Thank you. Thank you, Brent. I don't think anybody really knows what's going to happen Monday. I mean, literally anything can happen. We can have a big rebound in the equities and or gold. We can have a further sell-off in either or. If I had to bet, I think we're very likely to have a little bit of everything Monday. I think it's going to be really interesting, as they say, and we just have to weather it. I'm going to try and handle a little bit of that in the beginning of my presentation, but the majority of my presentation is built around the longer-term story for gold, why much higher gold prices, I believe, are inevitable. And if you believe in that thesis, then what we're going through now, you have to look at as a bit of an opportunity, as nerve-wracking as it can be. There are a lot of company representatives in here who saw their share prices drop 20% or more yesterday or during the process of the week. And they're a bit nervous going into PDAC, where you try to talk up your company, in some cases raise money. But I think it's all going to be much better when we look weeks and months down the road. So let's get into that a little bit. The new gold bull market. The title of this presentation used to be why it's here and what you need to do about it. And now the title of it, is it still alive? What's happened is we've got this contagion. The viral concerns have roiled the markets. And what it's doing is it's exposing cracks in the foundation that have already been there. The way I put it is that in my newsletter as of this week is that it's not the reason for the liquidity and the stimulus that we're going to see, but it is the excuse. And all of this was going to happen anyway. It just turns out that this is a very real and appropriate excuse. So this is what happened Thursday. This seemed pretty dramatic to me, and it is. And you see this cliff dive by the Dow. It tried to recover, and then markets got spooked, and toward the end, it crashed. Gold, on the contrary, was like an EKG. It would get hit by waves of selling, margin calls and the like. People who had to raise cash, they sold gold, and it would go down, but then you had waves of buying coming in. So it was back and forth, back and forth. That obviously stopped on Friday. The Dow plummeted again. The gold gave it up and couldn't hold on any longer, and the margin calls and the search for liquidity came in, and gold fell like a rock. And what I try to tell people yesterday on Twitter and other methods and some of the media is that this is the kind of thing that you expect to happen in this kind of an environment. Gold has done this before. Now, the parallels and the references to 2008 are very obvious, and even in the last 24 hours, they've grown to become a bit trite. But I really do believe that there's a rhyming that's going to happen there. That if this is in fact somewhat like 2008, and it already isn't, we have not had as steep of a drop in either the equities or gold as we had in 2008. But it was similar in that 2008 was a liquidity crunch. It was due to worries about the basic health and of the financial system, the global financial system. Here it's a health scare, but it's still serving to kind of expose these cracks in the system. Now, if it is rhyming somewhat with 2008, what does that mean? Let's look at what happened during 2008 in the financial crisis. At the early part of this, in September and October, August, September, October, you see these big drops. And we're talking about $150 in the gold price over the course of a few days. That's the kinds of drops that we had. Now, what happened, obviously, that was, again, a liquidity crunch. We had equity investors who had positions in gold, had to sell something, and gold was there and it was available to sell. Gold was back then, as I put it back then and as I put it yesterday, gold is the piggy bank that gets broken into in times of crisis. People said, well, why didn't gold go up? Why didn't it do its job? Its job is to rescue you. Its job is to be that insurance in times of crisis. It is the ultimate liquidity. You can sell it 24 hours a day. If you have physical metals, at least you can sell it 24 hours a day. All around the world, 7 days a week. But gold did what it was supposed to do yesterday, did what it was supposed to do in 2008. When something was available, when it was available to be sold, it was sold, cash was raised to reach margin calls. But as you can see from this chart, after that initial wave, that downturn, I mean, gold went down from, it was already over $1,000 before the crisis, and then it dropped to about $700. So that's a tremendous 30% drop right there. That happened in 2008. But after that, investors were able to look ahead and see this onrushing wave of central bank liquidity coming up, and they started buying gold. And this is what happened. Fear turned to greed, and investors bought gold in reaction to this unprecedented monetary stimulus that they saw coming down the pike. And the gold price more than doubled in the months following that. Now, I hope that's what's going to happen in this instance. I would be very happy with half this level of performance, because it would mean much higher, even record levels, record gold prices on a nominal basis. I think we're going to see something like that. And despite what's happened recently, there is a long-term picture that I'll go into for gold that virtually demands much higher gold prices over the long term. So a new round of stimulus was already baked into the cake. And this is what I was saying before. The coronavirus isn't the reason for the next round of currency creation. It's just the excuse. It only affects the timing. At some point this year, the Fed was going to cut rates again. Why? Doesn't matter. An excuse would have been made up at some point. The equity markets in the U.S. at least would have demanded from the Fed another round of rate cuts. It would have demanded more cowbell, as it were. It would have been more cuts, more easy money. And the only reason for that was because it's dependent upon that. It needs that next injection of easy money. So at some point, the stock market would have come up with some excuse to tell the Fed we need another round of rate cuts, and it would have happened. The coronavirus has provided that excuse, and it's brought it forward. Now, it is a very real excuse. Now, I'm not a doctor, I'm not an expert on the subject. I would recommend that you go to peakprosperity.com and look at their coverage by Chris Martenson and Adam Taggart, two good friends of mine. They've done a great job of it, of keeping up on the implications and the repercussions of this virus. So good a job that YouTube has just demonetized their videos and put the WHO link on top of all their videos. So they're trying to suppress what they're trying to say. Now, my view on the virus is that what we got Friday was indications that it's spreading outside China's borders. And actually, that came in Thursday and Friday. It's spreading outside China. China has actually done a fairly good job. It seems to be getting better in China, but it's escaped the borders, it's escaped containment, and it's spreading. The next big piece of news that I see down the road is the news that there are hundreds of people infected in the U.S. That has not happened yet. There's only 2 confirmed community-generated instances of the virus so far. I think there's going to be a lot more. This is going to spread. If past form holds true, it's going to be everywhere. At some point, it is going to be news that there is community transmission and there are hundreds of people in the U.S. infected. When that happens, that's going to be another jolt to the market. So we need to get ready for that. I don't know if the selling will be exhausted at that point. I don't know if there'll be any more for the market, for the equity market or the gold market to give at that point. But that's another round of bad news coming up that has yet to be digested by the market or shocked, to shock the market, and it's coming. So why was easier money on the way before this? This is why: federal debt. The federal debt, don't believe anybody who tells you that the federal debt is getting out of control. It already is out of control, and it has been for some time. The growth rate, trendline growth rate, is 8.7324% since 1900, even before the institution of the Federal Reserve. The trendline growth rate, again, is 8.7% a year over that time frame. And it's getting worse, because trillion-dollar deficits are back. It was $984 billion in 2019. It's already projected to be well over $1 trillion for 2020. The CBO, has come out and said basically we will never have deficits under $1 trillion again, and it's going to be somewhere between 1.2 and then more likely to 1.5 trillion a year toward the end of the next decade. The CBO is known, by the way, to underestimate these kinds of things. So it's bad, and it's getting worse quickly. Now, $1 trillion deficit is bad enough, but in reality, what happens is every year you'll have $1 trillion deficit. Then you look back, what's the debt today and what was it a year ago? And you'll find out that it's about $1.4 trillion higher than where it was a year ago, even though you only had a deficit of about $1 trillion. That's because there's another $400 to $500 billion of spending that's off budget, isn't counted. It's automatic, happens every year. So the rate of growth in the deficit, or in the debt rather, is much greater than you'll see in the mainstream media. This chart is pretty impressive. If you look at the first bump, you can't even really see it, I don't believe. The first bump being World War I, and that's the wrong one. The first bump being World War I, and the second bump being World War II. Now look what happened after 1971 when the last tie to gold was cut, and central banks could now spend with wild abandon and no repercussions, at least that they perceived. That's what happens when you have these eras of deficit spending. We don't have the excuse of a war. We have the reason of no restraint on money creation. And this is money being created over and over again. This is a year-over-year change. Now, what you're going to see is that rate is going to expand. It's going to increase very rapidly from here on. But imagine that chart after the stimulus that's about to come. Imagine that after the next $1 trillion stimulus spending plan, which is largely going to be wasted on so-called shovel-ready projects. That's what we see coming down the road. In my opinion, the next round of easing is going to be a rate cut. Obviously, that's the next step. But I think the Fed's going to have to not only do QE and not only do more than it's ever done before, but I think we're going to have to see massive fiscal programs, stimulus-oriented spending, even Fed purchases of corporate bonds and perhaps equities. Now, what does this debt mean? What are the implications of this for monetary policy, for the value of the dollar, and conversely, for the value of gold? Here you see a chart of the red line being federal government current expenditures, interest payments. The blue line is the gross federal debt. Now, nobody really knows. It's hard to find what the actual funding costs are for the federal debt because you have a number of securities, different maturities, different rates. It's a blended number, very hard to pin down at any point in time. So I just went to the Fed's website and found out what they're spending annually on interest expenditures and really just divided that by the gross federal debt. And the actual costs to service the debt tend to be 3% or so above the Fed funds rate, just as it's a broad gauge in normal times. The point being, it's much higher than people think. Now here we're tracking the interest payments in red, and then the federal debt in blue. As you can see, in 2008, that last gray bar, in that crisis, all of a sudden the debt started to grow tremendously. But because at the same time the Fed was lowering interest rates, going for zero interest rate policy, the cost of servicing that debt was ratcheting down. So that red squiggly line was kind of horizontal for a while. It really didn't go much higher. Then in December of 2015, the Fed came in with 1/4 point rate cut. And that's when you see that squiggly line all of a sudden start jumping higher. Then it was another year went by before they had another 1/4 point cut. And then the line really started to take off. The point here is that when the debt is so large, even a small increase in interest costs explodes the bottom line costs of servicing that debt. There's so much leverage in play with a federal debt that's large. And again, that federal debt is only getting larger by the day. So the new reality right now is the federal debt's so large that the service costs are crushing at any interest rate that's above the rate of inflation. Because what's the rate of inflation? That's the rate of currency depreciation. And what we've seen throughout human history is whenever a civilization has created these kinds of debts that it can't manage through growth or tax receipts, then the only option left is to depreciate the underlying currency. That's the inflation rate. So your costs of servicing the debt have to be lower than the rate that you're depreciating the currency when the debt is this large. Otherwise, federal budgets just get crushed. So the new reality is that ultra-low to negative real rates, they're not just likely going forward, they're absolutely necessary. From a fiscal standpoint, we can't afford positive real rates going forward. That's enormously bullish, as you're hearing from other speakers today, as Eric mentioned. It's enormously bullish for gold and silver for many years to come. This is a great chart from my friends at Incrementum AG. They do the In Gold We Trust report, the best work on gold annually. It's coming out this May. It's free. You need to get it and you need to read it. But you can see the blue shaded areas are generally areas where we had negative real rates prevailing. That gold line is the gold price. As you can see, in those blue shaded areas, that's when we had rising gold prices. When you had positive real rates, that's when the gold price was kind of handcuffed. Now, this is not a good chart. This got corrupted somewhere in the translation. So if you turn this, rotate this to your left or bend your heads. The orange line at the top or the right is the interest rate real U.S. yield curve a year ago. The next line down or to the left is black. That was 4 weeks ago. The blue line is this past week. So all along the curve to 30-year treasuries, rates are not only negative, but they're getting more and more negative. Again, this is powerfully bullish for precious metals prices. So what does the Fed do in times like these? Again, I did this chart Thursday evening. What I was talking about has, in the 24 hours, 48 hours since then, is just about already come to pass. What is the Fed's proven recipe to crisis? Step one, they cut rates. That may happen by Monday. We may see the first rate cut. I think if we see another opening at the bell when the equity market takes a nosedive, then I think the Fed will move quickly. I don't know what's going to happen, but the equity market may deliver that message to the Fed early on that it wants a rate cut. And they may come out with an emergency intra-meeting 1/4 point rate cut. And the odds of that have grown pretty strongly, as Eric covered earlier. So how low can you go? Well, we're about to find that out. If you look going back to the late 70s, in every instance of an economic slowdown, the Fed has cut rates considerably. On average, it's cut 5 percentage points, which we obviously don't have room to do right now. But look at the bottoms in each one of those rate cut programs, rate cut cycles. Each bottom, denoted by those red lines, is lower than the previous one, to the point where in post-2008, we got to zero. Now, I projected another red line somewhere below that off the chart because that's the next step down in the stairs, is below zero. Some people say that can never happen here. Fed governors, Fed presidents are saying, no, we can't have that in the U.S. We have central banks like Sweden saying, no, we're not going to do that anymore. It's counterproductive. But again, this is where the trend goes. If this trend continues and we're still in the same monetary regime that produced all the other bottoms, if this trend continues, this is where we're going. And this is not so much a prediction as to tell you that this is what's possible. The unthinkable is now possible because everything going on now today, if you think back 10 or 12 years ago, was unthinkable. And now it's been normalized. Step 2, quantitative easing. Another chart that got corrupted in the emailing. But if you can look at this one again, you see at the bottom there that the Fed had already begun quantitative easing and it kind of leveled off in recent weeks. But it had given back over 60% of its tightening beforehand. Over 60% in the span of a couple of months, or a few months, had already been erased. Now the Fed slowed down its purchases in anticipation of these supposedly temporary programs ending, but I don't think they can afford to do that again. In fact, the next round of quantitative easing will be greater than anything we've seen before. Bottom line, a new gold bull market is in progress. The long-term picture is clear, and the short-term, again, is interesting. These charts got corrupted again, but one of the things I wanted to show you on this is that the 14-week stochastic for gold is peaking again above 80. What we wanted to do is extend there. This is a longer-term 14-week chart. What happened Friday will not affect it. I think if we get back to the kinds of experiences we had in the early 2000s, it will remain above 80. Again, tough to read this chart, but what's happened in recent weeks is that gold and the dollar have been positively correlated. This doesn't normally happen. They are trading together. Gold has been rising with a rising dollar. So imagine if the dollar stops rising, if that uptrend ceases, where can gold go? Now, real inflation-adjusted gold, to get back to 1980 prices, it would have to get up to $2,800 today. That's an 86% rise from today's levels or the levels of earlier last week, and a 42% gain just to get to the peak of 2011. Silver is much greater upside. It has a 9-time multiple to get from current levels, more than that now, probably closer to a 10-time multiple to get to the levels that it was at in equivalent in the late 1970s. So you get leverage there. I'm a little bit over time, so I'm ending right now, fortunately. You can find me at goldnewsletter.com, New Orleans Investment Conference this year, October 14th to 17th, neworleansconference.com, and follow me on Twitter at Brien_Lundin, and we have a weekly podcast that a number of our speakers here have been on, and you can hear their unabashed, unhedged views on that podcast on a weekly basis.